This is our last pre-recorded video for 3351, pre-recording 21A, Chapter 21, Accounting Changes and Error Analysis. There's three types of accounting changes that exist. The first one is a change in accounting policy. So this is a change in the choice of a specific principle, rule, or practice. So an example of a change in accounting policy would be changing from first in, first out to weighted average. Another type of accounting change would be because the GAAP accounting standards that we use required us to implement a new accounting policy. The second type of change is a change in accounting estimate. So as part of accrual accounting, we're always making accounting estimates based on the best information we have at the time when we're preparing the financial statements. So a change in accounting estimate relates to just now receiving new information. So this would relate to a change in the useful life of an asset, estimate of how we're going to calculate our bad debts expense, and the net realizable value of accounts receivable would be examples. And the third type of accounting change is a correction of a prior period error. So if we have made a mistake or omitted something in the financial statements of the prior period or prior periods before that, and an error would be we had the information available to us at the time, but we didn't use it properly, or we should have gathered that information at the time. So it could be intentional or it could be an oversight. So an example would be failure to record depreciation at all. So that's something that's clearly an error that's been made, and that would meet the definition to correct a prior period error. It would be considered a prior period error as well once the financial statements have been released for that prior period and distributed to our users, and that we would have to take a different approach now for correcting that error. So back to changes in accounting policies. As mentioned, there's a change that's required by GAAP. So when the accounting standards, a new accounting standard comes out or a revision to an accounting standard, it will say how and when that change is to be adopted. So there would be a date that financial statements beginning on or after that date must include this change in accounting policy, and companies are allowed to early adopt that change if they like as well, because usually companies are given a couple of years before the change has to be made. Also, there could be a voluntary change between choice that already exists in GAAP. So you might use straight line method of depreciation for your cars, and now you want to use a units of production like a kilometers and activity rate instead for depreciation of your cars. Those are two different valid choices within the accounting standards. And you're allowed to do that if it presents more reliable and relevant information to the users about the effects of the transactions, events, or conditions on the entity's financial position, financial performance, or cash flows. So under IFRS, it has to meet one of those two reasons in order to change an accounting policy. We do not want companies to be constantly changing their accounting policies because it's disruptive, and we want to make sure we have comparable information. Under ASPE, there is a third type of change that a voluntary change can be made under certain specific accounting standards. Some investments in companies where we have a strategic investment, development phase expenditures, and these other three we haven't dealt with yet. Those are 3352 items. So it's important to remember that if you're changing from a policy, an accounting policy that was not acceptable or applied incorrectly, that would actually meet the definition of an error. Also, if we are just reclassifying items, for example, on my income statement or my balance sheet, I've now realized that a certain item, maybe my employee benefits, I had classified somewhere else, and now I'm just changing that classification within the expense line item. I can change the prior period for comparability, but it's not considered a change in accounting policy, just a change in presentation only. Accounting estimates, a few more examples of accounting estimates would be inventory obsolescence, the net realizable value of my inventory, the fair value of my investments, for example, my estimate for my warranty costs, my estimate for bad debts, my residual value for my intangible assets or capital assets, the useful life, etc., and patterns of consumption. If there's just been a change in the way we are using a particular asset now. So in my example previously with the car, if now the reason we're changing from straight line to units of production is because we're using the car very differently than we've done in prior years, that generally is treated as a change in accounting estimate because we've changed the way we're operating the business, we're using that asset. A change in accounting policy is we're doing the exact same things every year, but now we're using a different accounting policy to account for that. So same operations, but different accounting policies versus changing maybe a method of accounting policy because of the change in how we're doing business. So we'll do some examples of this one in class because it requires some judgment. So again, clarification between an estimation and an error. An error is an omission or a mistake. With information that we had available to us at the time that we didn't use or we didn't use properly. An estimation is approximation that we did with the best information we had at the time, but now things have changed. So for example, we accrue a liability for a lawsuit based on the best information we have. We estimate the amount of the legal liability, and then in the next accounting period, we get further information. The lawsuit goes to court. We owe more money than what we accrued. That difference between what we accrued last period and what we ultimately have to pay is reflected prospectively in the current accounting period because it's just a change in estimate. We didn't do anything wrong. Now we just have new information that has changed the measurement of that liability. Okay, so when we look at changes in accounting estimate, those are applied prospectively. So in the current period and going forward, the change in our useful lives of our assets, the residual values, bad debts, expense, warranty expense, all of those sorts of things that I used as examples, we have already been doing that where we say we will update for the newest information we have and treat it for the current period and going forward. Obviously, our assets and liabilities have to be appropriate based on at the balance sheet date. So there will be potentially some true ups or some adjustments to income in the current period that result from fixing up prior period estimates, like the example I just gave with the lawsuit. That's all considered prospective treatment. With changes in accounting policy, like I mentioned, last year we're operating the same way as this year, but we're using a different accounting policy this year. So the standards require us to apply retrospective treatment. And retrospective application means that we are going to have to restate the comparative periods, and we're also going to have to calculate the cumulative effect had we used that accounting standard since the beginning of time. So if that's impractical to do or it's not material, you can apply it prospectively. And this is the case for the most part with all accounting policy changes. The only difference would be is if it's a change in our primary source of GAAP from the handbook, and they specifically tell us in the standard that we don't have to retrospectively apply the change. So for change in an accounting standard, we go specifically to the standard to find out how we need to apply this change. Similarly, if we have a correction of an error, we will also retrospectively restate to adjust for the effect of the error. So how do we do retrospective, or sometimes what's called retroactive application? All comparative periods are presented as if the new, in this case it's the accounting policy, has always been used. It means that the opening balances of affected equity accounts are also adjusted for the earliest prior period that's presented. So if we're presenting 1 year prior as our comparative period and our year end is December 31st, 2020, and we are showing 2019 comparative information, and we would calculate the effect of the change in the accounting policy to update January 1st, 2019 opening balance of retained earnings. We would also show in the comparative income statements for 2019 the effect of the new accounting policy. So we would restate those items, and any other comparative amounts are also shown at the new amounts had the accounting policy always been in use. So this is for comparability purposes. We're comparing one period to the prior period, assuming the same accounting policy was used. And we're also cumulatively adjusting retained earnings had that accounting policy always been used, to the effect that we are able to do that calculation. Similarly with errors, we are going to make an adjustment for the error, and the prior period statements are restated as if the error had never happened. So at the top, it would say restated. So if you picked up this year's statements and you notice the comparatives are different from last year, there would be an explanatory note, and it would also say restated at the top of the statements that are affected. And if the effect is into retained earnings, again, you would see an adjustment to the beginning opening balance of retained earnings for the effect of the error. So this concludes pre-recording 21A.